Introduction to corporate restructuring. Corporate restructuring refers to significant changes in a company's organizational, financial, or operational structure designed to improve efficiency, enhance shareholder value, or respond to changing business conditions. Restructuring transactions can alter ownership, capital allocation, business focus, and competitive positioning. Companies pursue restructuring when management believes the market is not fully recognizing the value of specific assets or business segments, when operational performance requires improvement, or when strategic objectives change. For analysts, understanding restructuring is important because these transactions often have significant implications for valuation, risk, financial reporting, and future profitability. Successful restructurings can unlock hidden value and improve long-term corporate performance. Types of corporate restructuring. Corporate restructuring can take many forms, including spin-offs, split-offs, carve-outs, divestitures, liquidations, and leveraged recapitalizations. A spin-off creates an independent company by distributing shares of a subsidiary to existing shareholders. A split-off allows shareholders to exchange shares in the parent company for shares in a subsidiary. Carve-outs involve selling a minority interest in a subsidiary through a public offering while retaining control. Divestitures involve the sale of business units or assets to external buyers. Liquidations distribute company assets to claim holders after operations cease. Each restructuring method has unique strategic, financial, and tax implications that influence value creation and shareholder outcomes. Motivations for restructuring activities. Companies undertake restructuring transactions for several strategic reasons. Management may seek to improve operational focus by separating unrelated business segments, allowing each entity to pursue independent strategies and capital allocation policies. Restructuring may also help eliminate inefficiencies, reduce agency conflicts, improve transparency, and highlight undervalued assets. In some cases, regulatory requirements, antitrust concerns, financial distress, or changing industry conditions motivate restructuring decisions. Companies may divest non-core assets to strengthen balance sheets, improve profitability, or raise capital. Ultimately, restructuring is often driven by the belief that the value of individual business components exceeds the value currently reflected within the consolidated organization. Valuation considerations in restructuring. Valuation plays a central role in restructuring decisions because management must determine whether a transaction will create economic value. Analysts frequently use discounted cash flow analysis, comparable company analysis, precedent transaction analysis, and asset-based valuation approaches when evaluating restructuring opportunities. Different business segments may have distinct risk profiles, growth prospects, and capital requirements, resulting in different valuation multiples. A restructuring transaction may reveal value that was previously obscured by conglomerate structures or inefficient capital allocation. Accurate valuation requires consideration of transaction costs, tax consequences, financing effects, and potential operational improvements that may arise following the restructuring process. Sum of the parts valuation approach. One of the most important valuation techniques in restructuring analysis is the sum of the parts (SOTP) approach. This method values each business segment separately and then aggregates the values to estimate the overall worth of the enterprise. SOTP analysis is particularly useful when a company operates in multiple industries with different growth rates, risk characteristics, and valuation multiples. If the combined value of the individual segments exceeds the market value of the consolidated company, analysts may conclude that a conglomerate discount exists. Restructuring transactions such as spin-offs or divestitures can potentially eliminate this discount and unlock shareholder value through improved market recognition. Evaluating potential benefits of restructuring. The evaluation of restructuring proposals requires assessing both strategic and financial benefits. Potential advantages include improved management focus, enhanced operational efficiency, stronger corporate governance, more effective capital allocation, and increased transparency for investors. Separate business entities may receive valuation multiples more consistent with their individual characteristics rather than being valued as part of a diversified organization. Additionally, restructuring can reduce complexity, improve accountability, and attract specialized investor bases. Analysts should estimate expected synergies, cost savings, revenue opportunities, and capital structure improvements to determine whether the proposed transaction is likely to generate sustainable shareholder value over time. Risks and challenges of restructuring transactions. Although restructuring can create value, It also introduces risks and uncertainties. Transaction costs, tax liabilities, legal expenses, operational disruptions, and execution challenges may reduce expected benefits. Management may overestimate synergies, underestimate separation costs, or face difficulties establishing independent operations. In addition, market conditions may change before the transaction is completed, affecting valuation outcomes. Some restructurings may reduce diversification benefits or increase financial risk if leverage rises significantly. Analysts should carefully evaluate assumptions underlying management projections and consider both short-term implementation risks and long-term strategic implications before concluding that a restructuring transaction will enhance shareholder value. Analytical framework for restructuring evaluation. A comprehensive evaluation of restructuring requires integrating strategic analysis, valuation assessment, financial statement analysis, and risk evaluation. Analysts should determine whether the transaction improves economic efficiency, enhances transparency, strengthens competitive positioning, and increases the present value of future cash flows. The assessment should include analysis of business fundamentals, capital allocation policies, financing arrangements, tax consequences, and potential changes in corporate governance. Successful restructurings generally create value by improving focus, reducing inefficiencies, and allowing investors to more accurately assess business performance. For CFA candidates, understanding restructuring motivations, valuation methods, and evaluation techniques is essential for analyzing corporate transactions and investment opportunities.